You've probably heard that investing is the only reliable way to build real wealth, but every time you look at the news, it feels like the financial sky is falling. If you are currently keeping all of your hard-earned cash stuffed under a mattress or sitting in a basic savings account, you are secretly losing money every single day. That invisible thief is called inflation, and it quietly eats away your purchasing power while you sleep. But stepping into the world of investing can feel like walking directly into a trap, especially when the media constantly screams about market crashes and economic doom. You might feel like the stock market is just a giant rigged casino designed to enrich the wealthy while leaving everyday people to pick up the pieces. Don't panic, because the truth is much simpler and far less terrifying once you understand the hidden mechanics behind the curtain. Today, we're going to completely demystify the stock market, break down exactly how your money grows, and show you how to take control of your financial future. At its core, the stock market is just a massive global grocery store where people buy and sell tiny slices of businesses. When you buy a stock, you aren't just buying a flashing ticker symbol on a digital screen, you are buying a legitimate piece of a real operating company. If that company sells more products, invents better technology, or expands its services, the business becomes fundamentally more valuable. Some of these companies even pay you a portion of their profits every quarter just for holding the stock, which is a sweet bonus known as a dividend. When a company becomes more valuable, more people naturally want to own a piece of it, which drives the price of your slice up. This creates the classic battle of supply and demand that dictates every single price movement in the financial world. When everyone is optimistic and rushing to buy, demand outweighs supply, driving prices higher in what we call a bull market. You can picture a bull thrusting its horns upward, symbolizing a strong, growing economy where investment portfolios are expanding. On the flip side, when fear takes over and people rush to sell their shares to get cash, supply floods the market. This excessive supply drags prices down, creating a bear market, pictured as a bear swiping its heavy paws downward. Bear markets are completely normal and historically temporary, yet they cause immense psychological stress for new investors. But who or what actually triggers these massive waves of optimism or fear in the first place? A lot of it comes down to a powerful central institution known as the Fed. The Fed acts like the driver of the economic car, using a giant lever called interest rates to control the speed of the economy. When the economy is sluggish and needs a boost, the Fed lowers interest rates, making it incredibly cheap for businesses and people to borrow money. Cheap money means companies can build new factories, hire more workers, and expand rapidly, which usually sends the stock market soaring. However, if the economy runs too hot and prices for everyday goods start rising too fast, inflation becomes a massive problem. To cool things down, the Fed pulls the lever in the opposite direction, raising interest rates and making borrowing more expensive. Higher borrowing costs force businesses to slow down, consumers to spend less, and stock prices to temporarily drop as the market adjusts. The financial news media thrives on this exact cycle, turning every minor move the Fed makes into a breaking news emergency. They use sensationalized headlines, flashing red graphics, and panic talking heads to keep you helplessly glued to the screen. Always remember that the news is a business designed to sell your attention to advertisers, not to give you calm, rational financial advice. This brings us to the biggest danger you face as a beginner investor: your own highly reactive brain. Human beings are hardwired by evolution to react aggressively to perceived threats, which is great for avoiding predators, but terrible for managing a retirement account. When the market dips and your portfolio flashes red, your brain's fear center screams at you to sell everything and run to safety. Giving into this fear means you are permanently locking in your losses, selling your shares at the exact moment they are cheapest. Conversely, when the market is booming and your neighbor starts bragging about their overnight millions, you experience the dangerous fear of missing out. FOMO causes amateur investors to blindly buy into hype at the absolute peak of the market, right before the inevitable crash. To protect yourself against these wild emotional swings, you should use a mechanical strategy called dollar cost averaging. This simply means you invest a fixed amount of money on the exact same day every single month, regardless of what the news is saying. If the market is up, your fixed amounts buy fewer shares, but your existing portfolio goes up in value. If the market is down, your fixed amount buys a huge number of shares at a heavy, profitable discount. Over time, this strategy smooths out the chaotic bumps of the market and completely removes the pressure of trying to time the perfect entry point. The secret to long-term wealth is removing emotion entirely from the equation and behaving like a cold, calculating machine. So if trying to time the market is a trap, how do you actually win the game? The answer is something that has been called the eighth wonder of the world, the mathematical magic of compound interest. Compound interest is simply the snowball effect applied to your money, where your initial investment earns money, and then those earnings start generating their own money. Imagine rolling a small, tightly packed snowball down a massive, endless snow-covered hill. At first, it grows slowly, but as it gains momentum and surface area, it begins to pack on massive amounts of snow with every single revolution. In the stock market, time is the endless hill, and your consistent monthly contributions are the snow. Let's say you invest a small amount of money every single month into a broad index fund that tracks the top 500 companies in the country. An index fund is essentially a giant basket containing tiny pieces of hundreds of different successful companies all bundled together. If one company in the basket fails and goes bankrupt, it barely makes a dent because the hundreds of other successful companies hold the basket up. This massive diversification dramatically lowers your overall risk compared to betting your entire life savings on a single trendy tech stock. In the first few years of investing this way, the growth might look unimpressive, and you might wonder if it's even worth the effort. But if you leave it alone and keep contributing for 10, 20, or 30 years, the math becomes absolutely staggering. The interest piling on top of interest causes your portfolio line to curve sharply upward in a massive, unstoppable hockey stick shape. The most crucial factor in this entire wealth-building equation isn't how much money you make right now, but rather how early you start the clock. A 25-year-old investing a small portion of their paycheck will effortlessly outpace a 45-year-old investing 3 times as much. This happens simply because the younger investor has given their money more time on the compounding hill to grow. The path to financial freedom does not require a fancy finance degree, a tailored Wall Street suit, or a magic crystal ball. It requires the discipline to spend less than you earn, the courage to start investing today, and the patience to let time do the heavy lifting. Stop letting invisible inflation steal your future, and stop letting the financial news dictate your emotional state. You now have the fundamental blueprint to navigate the mechanics of the market, understand the forces of supply and demand, and use compounding to your advantage. Your journey to real, lasting wealth begins with a single, confident step forward into the market. If this video helped clear the fog around investing, hit the subscribe button below so you never miss another guide. Leave a comment below telling me exactly what confusing financial concept you want me to demystify next. Until then, keep your emotions in check, stay the course, and watch your wealth grow.